They told you that if you buy an S&P 500 index fund, you own a piece of America. They told you that you are a shareholder, a true capitalist. They lied. What if I told you that you don't own your stock? That you own a claim to a stock, but someone else, one company, actually owns the shares, casts the votes, and decides the direction of virtually every major corporation you interact with every single day? The company I'm talking about is BlackRock. It's not a bank. It doesn't make loans or take deposits. It is an asset manager, and its power is so vast, so silent, and so deeply embedded in our economy that it presents a fatal challenge to the very idea of competition, free markets, and even democracy. We are not just talking about money. We are talking about the concentration of pure, systemic economic control in the hands of a single, unelected entity. This is the $10 trillion question. Why is BlackRock more powerful than any bank, any company, or any previous monopoly in history? The answer isn't just in the money it manages, but in the 5 unseen mechanisms it uses to control ownership and policy across the entire global economy, mechanisms that are pushing our system toward a serious crisis. Let's start with the sheer size of the problem. BlackRock manages roughly $10 trillion in assets. To put that number into perspective so it actually means something to you, $10 trillion is a sum larger than the entire economic output, the GDP of every single country on Earth, with the exception of the United States and China. It manages more money than the economies of Japan, Germany, and the United Kingdom combined. It's a sovereign wealth fund without a sovereign country. This giant controls money for pension funds, insurance companies, university endowments, and you, the retail investor, through index funds and ETFs. These funds are designed to own everything, and that is precisely where the doomed future of competition begins. When you invest in an S&P 500 ETF, BlackRock takes your money and buys shares in all 500 companies. This is how they collect their massive voting power. You have outsourced your voting rights to them. You are economically invested, but politically disenfranchised within the corporate world. BlackRock is the largest or second largest shareholder in 495 of those 500 companies. This is not a conspiracy. It is a documented market structure that is legally permitted. Now, we need to explore those 5 mechanisms because they show exactly how a legal asset manager can become the ultimate financial oligarch. In the 20th century, a monopoly meant one company controlled one industry. Think of John D. Rockefeller's Standard Oil in the early 1900s. They controlled 91% of oil refining in the U.S. That was a visible crude monopoly, and eventually the government broke it up into 34 smaller companies. BlackRock's control is invisible and far more insidious. They don't control 91% of one thing. They control about 6% to 8% of everything. Let me give you some specific, concrete numbers that should make your jaw drop. Tech. BlackRock owns about 6.8% of Apple, 7.1% of Microsoft, 6.2% of Amazon, and 6.4% of Google, Alphabet. Banking. They own 6.8% of JP Morgan Chase, 7.3% of Bank of America, and 6.2% of Goldman Sachs. Energy. They hold 7.2% of ExxonMobil and 7.1% of Chevron. Pharmaceuticals. They own 8.1% of Pfizer and 7.4% of Johnson & Johnson. Do you see the pattern? They own significant top-tier stakes in all the competitors within a given industry. This creates a serious, urgent problem known in economics as common ownership theory. If you own 7% of Delta Airlines, 7% of United Airlines, and 7% of American Airlines, you don't care which one wins a price war. In fact, you would prefer they don't compete aggressively on price. Why? Because competition is bad for the shareholder who owns them all. If all the airlines raise their prices, your 7% stake in all 3 benefits. The incentive is clear: suppress competition, maximize industry-wide profits. Studies have shown this is not just theoretical. Economists found that airline ticket prices are 3% to 7% higher due to common ownership by BlackRock Vanguard, and State Street. The same thing happens in banking, where banks with common ownership pay lower interest rates on deposits and charge higher rates on loans. This is the ultimate monopoly by proxy. BlackRock doesn't need to break the law to raise prices. They just need to use their ownership influence across the board. The result? Billions of dollars transferred from consumers that's you to shareholders, which is mostly BlackRock. Since BlackRock holds the legal title to your shares, they control the votes on corporate boards, executive pay, mergers, and corporate strategy. This is where a single man's preferences become corporate law for America. That man is Larry Fink, BlackRock's co-founder, CEO, and chairman. Every year, Fink writes a public letter to the CEOs of the companies BlackRock is invested in. These letters are not polite suggestions. They are directives backed by $10 trillion in voting power. If a CEO ignores Fink, BlackRock can vote against their board members or their compensation. Fink has used this power to push a strong agenda, particularly focused on ESG, environmental, social, and governance criteria. In recent years, his letters have told companies to disclose climate risks, align with the Paris Agreement, and set diversity targets. You can agree with the goals of climate action or diversity, but that is not the point. The point is the mechanism of power. One single unelected individual is setting the strategic policy for 500 of the world's largest companies, bypassing democratic accountability and traditional shareholder governance. Fink has more voting power over corporate America than any individual in history, including all previous industrial magnates. He doesn't have to be elected. He only has to manage your money, and because index funds are so cheap and convenient, billions flow in automatically, amplifying his influence every single day. This is a severe threat to governance that leaves the system doomed to serve the interests of the oligarch, not the customer or the worker. If BlackRock's concentrated ownership is its economic engine, the Aladdin system is its central nervous system. Most people have never heard of it, but it is their most powerful and arguably most dangerous piece of infrastructure. Aladdin is a proprietary software platform. The acronym stands for Asset, Liability, Debt, and Derivative Investment Network. It was built to manage and calculate risk for investment portfolios in real time. Here is the urgent scale. Aladdin manages risk for $21 trillion in total assets. This is not just BlackRock's $10 trillion. It is licensed to over 200 institutional clients worldwide, including major pension funds, insurance giants like AIG, sovereign wealth funds, and even rival asset managers. That means BlackRock's system sees and analyzes risk across roughly 10% of the world's total financial assets. Why is this so terrifying? Because Aladdin is a black box. Its algorithms are secret. BlackRock doesn't disclose how it calculates risk. If Aladdin identifies a risk, it recommends an action, a sale, a purchase, and because hundreds of institutions rely on it, its recommendations can move markets simultaneously. If that sounds familiar, it should. The 2008 financial crisis was caused, in part, because banks used similar but separate flawed risk models. When the housing market collapsed, all the models failed simultaneously, causing a systemic cascade. Now, imagine that same scenario, but instead of multiple models, it's one single model, Aladdin, controlling $21 trillion. If Aladdin miscalculates risk, or if a bug occurs, the simultaneous action it recommends to all its clients could trigger a massive, interconnected collapse across the global financial system. BlackRock has the ultimate insider view on systemic risk, an information advantage that is unlike anything we have ever seen. They see what institutions are buying and selling before the market does. This is a fatal concentration of data dominance. The most direct way BlackRock exercises its power is through the government itself. This is not a theory. It is a demonstrable fact that a strong revolving door exists between BlackRock and the highest levels of U.S. economic policy. This is how policy aligns with BlackRock's interests, not the other way around. We saw this play out during the COVID-19 pandemic crisis. In March 2020, when markets crashed, the Federal Reserve needed to intervene, but the Fed is restricted from buying corporate bonds and ETFs directly. So, who did the Federal Reserve hire to execute this massive, unprecedented emergency program? BlackRock. BlackRock was contracted to buy corporate bonds and ETFs on behalf of the Fed. In essence, they were hired by the government to stabilize a market in which they were the largest player. They charged fees for this service and bought assets, including, in some cases, BlackRock's own ETFs, using Fed money. They were player, referee, and scorekeeper all at once, profiting directly from the government intervention they were hired to manage. This is the definition of regulatory capture in action. The reverse flow is just as urgent. Top BlackRock executives routinely move directly into high-level government roles. Brian Dees, BlackRock's global head of sustainable investing, left to become the director of the National Economic Council under President Biden, the president's top economic advisor. Michael Pyle, BlackRock's global chief investment strategist, became chief economic advisor to Vice President Kamala Harris. Adewale Wally Edemo, a former BlackRock chief of staff, is now the deputy treasury secretary. These are the people who help write the financial sanctions, the banking regulations, and the climate policies. When BlackRock executives write the rules, those rules tend to benefit large asset managers like BlackRock, while hurting smaller competitors. This dynamic echoes the era of the J.P. Morgan Trust in the late 1800s and early 1900s. J.P. Morgan controlled a vast web of companies through interlocking directorates, where Morgan partners sat on the boards of U.S. Steel, General Electric, and hundreds of others. His power was personal and direct. Eventually, the government broke up his empire with the Clayton Antitrust Act, which banned interlocking directorates. BlackRock learned this lesson. They don't put Larry Fink on corporate boards. They own the stock and vote the proxies. The power is indirect, but more absolute, and thanks to the revolving door, their legal structure is practically bulletproof. The final piece of this puzzle is the relationship between BlackRock and its two largest competitors, Vanguard and State Street. The three firms are often called the Big Three. When you look at who owns BlackRock itself, you find that the largest shareholder is Vanguard, about 8%. And who are the largest shareholders in Vanguard's own funds? They are largely the same companies BlackRock invests in, and BlackRock holds major stakes in those companies too. This creates a terrifying loop called horizontal shareholding. Vanguard owns BlackRock. BlackRock owns the companies Apple, Microsoft, etc. Vanguard also owns those companies. State Street is the third largest player, and BlackRock and Vanguard are major shareholders in State Street. Collectively, these three firms own about 20% of every S&P 500 company on average, and they own each other. This is a structure of self-reinforcing circular power. In the 20th century, a monopoly was one company dominating one market, like Standard Oil owning 91% of oil refining. In the 21st century, an oligopoly is three companies owning 20% of everything and owning each other. Competition is suppressed, but the structure is legal because no single firm has a majority control over any one company. They have a coordinated minority control over all companies. This concentration of control ensures that the vast majority of our capital is managed by a small interconnected group with the same incentives: to keep labor costs low, to keep prices high, and to resist any disruptive competition that might challenge their dominance. So let's put it all together. BlackRock isn't just an investment firm. It is a fusion of financial power, political access, and technological dominance that is unlike any force we have seen in economic history. It is a $10 trillion asset manager that uses its proxy votes to dictate corporate policy to the companies you buy from. It has a $21 trillion AI system that provides an exclusive systemic information advantage. Its former executives write the financial rules from inside the White House and the Treasury, and it sits at the center of a circular ownership structure with its two largest rivals. ensuring that competition is not only discouraged, but structurally impossible. This is the ultimate legal ownership monopoly. This isn't just an economic topic. This is the fatal reality of how power works today. It is a system where the consumer pays more, the worker is paid less, and the corporate boards answer not to millions of individual shareholders, but to the directive of one man who has built the perfect engine for accumulating invisible absolute power. This silent takeover has massive real-world consequences for your wages, the price of your groceries, and the future stability of the entire global financial system. The structure is accelerating, and the time for addressing this urgent crisis is now, before the Big Three's control becomes absolute. The story of BlackRock is the story of how a rational choice buying a low-fee, convenient index fund creates an irrational, deeply concentrated systemic outcome. Your effort to be a smart, passive investor is what makes BlackRock the economic overlord of the 21st century. We have moved beyond the competition-driven capitalism that created this country's wealth. We are now living in a financial oligarchy where one company is player, referee, and scorekeeper, and the only path to change requires understanding the scale of the problem and demanding that the law catches up to the structure. This silent dominance is why BlackRock is more powerful than any bank in history, and it is a development that leaves our system doomed to serve the interests of the few. If this breakdown of financial power opened your eyes to how the system actually works, hit that subscribe button.